Hello, everyone. In this part of the presentation, I will introduce the background, purpose, and scope of our review. Sheldon Audiovisual Limited is currently below the statutory audit threshold. However, because the company is considering future public listing, an early review of its control environment is still essential. The purpose of the review is to evaluate the company's control environment and identify any factors that may increase audit risk. This is important because weaknesses in the control environment can increase the risk of material misstatements. Next page. The review includes 6 elements: management's philosophy and operating style, integrity, ethical values, and competence, communication, information systems, assignment of authority and responsibility, and human resource policies and practices. Next page. Alright, when it comes to element 1, management philosophy and operating style refer to the way management runs the business, responds to pressure, and approaches control and reporting. In Sheldon Audiovisual Limited, management appeals to place strong emphasis on performances and business growth. This may help improve efficiency and support development. At the same time, management also seems to value formal procedures and financial reporting compliance. However, from an audit perspective, a strong focus on results may also create pressure to achieve targets. When performance pressure becomes too high, there is a greater risk that management may use overly aggressive accounting judgments or biased estimates in financial reporting. Therefore, auditors need to remain professionally skeptical. In particular, we should pay closer attention to management estimates, year-end adjustments, and any area where judgment is significant. Overall, management style may support business performance, but it also creates potential audit risk if business pressures start to outweigh control discipline.
Dear auditor, manager, and partner, our review of integrity, ethical values, and professional competence is negative. First, there is integrity defects exist. The managing director, David Sheldon, bypassed approval limits. Management covered over inventory control failures, and personnel art was capitalized, overstating assets. This shows a poor tongue at the top and clear brand risk. Second, we found earning management. Equipment disposal with £11,000 book value generated £12,400. Other income unexplained. Capital expenditure like bullions were explained, understanding assets. Third, staff complacency is weak. Purchase approval, lack of segregation of duties, and £24,000 year-end goods worth accurate dealing liabilities recognition. In summary, management integrity and ability are deficient, creating high risk of material misstatement. In substantive testing, we will focus on management override, assets evaluation, and liability completeness. The third one, we give a negative evaluation for communication. Systematic deficiencies exit, blockade upward channel silos, and no formal mechanism. Upward communication fails. Management relies on feelings. Employees fail to speaking up, so frontline issues do not reach decision makers. Silence, assets management, and finance never recognize. Warehouse receipts are not sent to finance, leaving goods received at and after year-end unrecovered. Sales and finance disconnected, delaying receivables updates. Formal mechanisms are absent. Purchasement approval are unclear. Self-approvals occur. Emergency purchases bypass capex form. No supplier recognitions or follow-up confirmation. This communication failures creates misstatement risk, especially for cutoff, payables completeness, and receivables accuracy. We will expand cutoff testing and strengthen confirmation procedures.
Now, cover the fourth element, assessment of authority and responsibilities. I found 3 main problems. First, unclear roles. Finance Director James Culloch, Margaret said, it never comes over little if any input, paid a massive salary, but it's hard to see what he does. Company Secretary Leanne Sheldon, staff say we never see her, makes you wonder what she does. My view, appointments seem based on relationships, not ability. Recommendation reveal these roles. Second, too much power with Rose. David said, I leave everything to Rose. Only Rose understands the spreadsheets. She was supposed to train Jenna, but never got around to it. My will, no oversight of finance roles, no training others is a red flag. Recommendation, cross-training now. Roles must document spreadsheets and try and back up. Third, uneven workload, rob call. Overworked and underpaid. Kelly, always short of work, borrowed. Margaret suggests Kelly helped in payroll. Rose told her to stop interfering. My will management rejected a good solution just because a staff member suggested it. Shows a closed attitude. Recommendation management training creates channel for staff suggestions. Summary power and responsibilities are unclear, over concentrated. Lack oversight, a major weakness.
We've identified several key areas of concern. Firstly, there's a significant lack of clear delegation and oversight, while the board of directors holds ultimate responsibilities. James Clark, despite his title, appears to have minimal input. Conversely, David Sheridan heavily delegates to Rosie Hendricks, who effectively controls the finance department without formal, explicit authorization. This concentration of power in Rosie creates a one-person finance department risk. Next, we observed undefined roles and responsibilities. Some employees, like Lynn, have unclear job functions, while others, such as Kaylee, are underutilized. This contrasts with employees like Rob Cole, who seem to be overworked due to an uneven distribution of tasks. Then, there's a notable lack of segregation of duties, particularly in financial processes. For example, in accounts payable and capital expenditures, the same individuals are involved in initiating, approving, and recording transactions, increasing the risks of errors and fraud. Finally, we see an instance of management override of policies. David Sheridan has been noted to bypass established approval limits for capital expenditures, indicating a disregard for internal policies and potentially leading to moral risks. These issues collectively suggest a weak control environment in this area, impacting operational efficiency and the reliability of financial reporting. Addressing these points is crucial for strengthening Sheridan AV's internal controls.
Hi everyone, I will introduce the human resources policy and practice of shared AV. I found a serious gap in the training. Roles had never trained Jenna, so the key knowledge is in one person. This is a key independence risk. Accountants also made mistakes in terms of deadline, deterioration, and capitalization. Although the risks are obvious, there is no provision for bad debates. When the staff is incapable, the risk of major misreporting will increase. I also find that the workload is uneven and poor happiness. Jenna has now taken annual leave for 2 years, and the management doesn't know. Roboco works too much and is paid too low, while others have nothing to do. This will lead to low morale and employee turnover. Finally, there is no formal channel for employees to express their concerns. Margaret calls the adults directly instead of reporting the problems is still hidden. So I recommend, first of all, test the area of knowledge conservation, especially Rosie's spreadsheet. Second, review the leave records. No vacation for a long time may mean hidden problems. Third, due to the lack of training, the examinations is substantive and should be incorporated in the examination. Fourth, ask if there is a reporting policy. If not, record it as a weakness. Finally, expand the specific testing of sales leaders, procurement leaders, and fixed assets. In short, there is an obvious gap which will reduce the dependence on control and increasing testing. Thank you.
Conclusion. Now for my overall assessment and audit implications. Overall assessment, turnover nearly doubled, but control environment hadn't kept up. The company still runs like a small family business. Oral communication, not written. Personal trust, not formal controls. One person runs finance. No prepare management accounts back or a secret package still. My view, directors haven't realized growth requires systematic change. Implications for audit. First, the control risk is high, cannot rely on internal controls. Second, extensive substantive testing, increase sample size, test throughout the year, focus revenue, inventory, payroll, related parties. Third, maintain professional SCI system, especially where roles controls the numbers. Fourth, report deficiencies to management under ISA 265. Final conclusion, Sheldon AV at a crossroads, good growth, but control environment not ready for this audit or future listing. Audit approach, extensive testing, professional SCI system, clear feedback. Thank you.